So the format of this evening, we will hear in sequential order from our my colleagues Vera, Michael, and Claire, who will all in due course introduce themselves and their titles and topics. After we've heard from them, we won't move to questions to the speakers immediately. We will then be joined on the stage by yet more luminaries of public policy, Vicky Price, Torsten Bell, another think tanker, and my predecessor as SMF director, Emran Mian, who now I think glories in the title of Director General of Higher Education at the DFE. And he's modestly agreeing, and so a man very well placed to talk about the intersection of the sort of expertise that is offered in this report and the making and implementation of public policy. So that is almost all you'll hear from me. I may pop up again briefly later, but for now I will hand over to Vera.
Thank you very much. Good evening, everybody. Thank you very much for coming. My name is Vera Turger, and I will be presenting a part of the policy report that I and my co-author, Thomas Plümper, who is sitting there in the back, you can wave, contributed to this policy report. I also had the good fortune of being in charge of putting this policy report together, and so I really hope that everybody who is here will find a little piece in the policy report that they find interesting or helpful in any way. So one of the things we contributed to this policy report was thinking a little bit about what kind of welfare state and what kind of welfare policies does the UK contribute. And when we look at the UK welfare state, then we can see that by continental standards, it's more like a reluctant welfare state. So even though almost 50% of the UK tax revenue are spent on social protection, healthcare, and housing, this is still very much smaller than in most other continental welfare states. On the other hand, the UK also seems a little bit like a fragile welfare state, because private debt at the moment is almost 150% of household income. That's mostly due to mortgages, but also private debt that is consumption related is rising. And especially with a potential downturn in the economy caused by the uncertainty of Brexit, and therefore potentially increasing prices and higher interest rate, that might actually bring a lot of families in this country to the brink of bankruptcy or even poverty. So there are a lot of people, or politicians, mostly on the left side of the spectrum, that believe that spending more on welfare policies, so increasing the welfare state, deepening and widening the welfare state, and by that Europeanizing the welfare state, could actually solve this problem. So the question that we are asking in a comparative perspective is really, is bigger better, or is only better better? And you probably already can guess the answer to this. Only better is better, but we want to really look at the UK welfare state in comparison. So when we look actually at what happened over the past couple of decades in Europe, then we can see that mostly, of course, left-wing parties, social democratic parties, and unions that are seen as being responsible for an increase in welfare state policies and welfare state spending, have actually undergone a severe crisis. Even in the strongholds like Germany, votes for social democrats have almost halved. But when we look at welfare state spending, we almost see no decline, or we even see rather an increase in welfare state spending across most European countries, and as well in the UK. Of course, this might be mostly due to the aging of society. So a lot of this comes from, more healthcare spending when you have older people, more investment in pensions, public pensions, and so on. But if we look at the UK, then this increase is still there, but it's much smaller than in other European countries, especially continental welfare states. So if we look at, for example, the Party Manifesto of Labour in 2017, they suggested to increase spending on public housing, to spend another 30 billion on the NHS, to increase unemployment benefits, and so forth. And overall, even if we factor this in, that would be about 50 billion if Labour really fulfilled all these promises. The UK welfare state would still be far away from what we see in continental welfare state. So the welfare state spending would have to increase by more than double to get close to per capita spending as in Germany, which has almost the highest welfare spending in Europe. So, of course, we all agree that welfare policies should be rather a means than an end, right? What we are interested in, and the goal of welfare state policies should be outcomes, right? So welfare state policies should target goals like long lives, a good healthcare system that provides health and longer living, reducing poverty, as well as potentially increasing upward social mobility. So if we look at this in comparison, what we really see is that there's only a very weak link between what is actually spent on these policies and what the outcomes are. So for example, the left side panel here shows the relationship between social transfers and poverty reduction. And of course, poverty reduction is quite often measured as the share of the population that earns 50% less than the mean. So it's really more kind of an inequality measure here. But what we can see is that even though the UK only ranks second to Ireland in what they spend on transfers, it basically is close to the average in terms of relative poverty with regard to other welfare states. So there might be two explanations. One is, of course, that a lot of these countries or a lot of these policies do not really cater to the poor. So they do not really provide transfers to the poor, but they reduce relative poverty by a progressive tax system, so by making the median earner worse off. The other potential explanation for this might be that, of course, more spending on transfers requires higher social security contributions, for example, and that might increase labor costs and therefore reduce the demand for labor and really contributes to the problem that it's supposed to solve. When we look, for example, at health spending and outcomes, what we see here again is that there's just a very weak link between what is actually spent and life expectancy. So, for example, when you look at Germany, right, it has the highest healthcare spending in all these European countries per capita, and it still only comes second to Portugal in terms of life expectancy. So clearly there's no strong link between spending and outcomes. One of the other reasons one of the goals should, of course, also be potentially increasing upward social mobility, even though education spending might not be at first sight really be aimed at increasing social mobility, but any kind of educational policy that does not cater towards upward social mobility is actually redistributing to the richer part of the society than to the poorer part of the society. So what we can see here is like only Finland really is quite good in terms of upward social mobility. Countries that spend a lot on education like Germany, for example, again, Denmark, really have not such great success with increasing upward social mobility. So what do we learn from this exercise, really? So in general, and this is just very descriptive analysis, but what we can see in general is that welfare state spending is only weakly correlated with the desirable outcomes we are interested in. Of course, bigger welfare states always mean higher taxes, more debt, or larger social welfare contributions. So everything else equal, right? So outcomes equal, we would prefer lower welfare spending, lower taxes, and a smaller welfare state. So really, the question here is that whether redistribution from the taxpayer to the government does not necessarily always mean that outcomes improve. So really what is also weaving through like a red thread through this whole policy report is that more is not always better, right? So it's really mostly about the design of the policy as well as funding, but about the design of the policy to improve outcomes. So for example, designing policies for the poor, right? There's one contribution by Anandi Mani and James Kirkup, who actually really show that it's really about policy design when you design, for example, things like universal credit. Or it's not necessarily the case that just increasing spending on education will improve social mobility or other types of outcomes, or just spending on infrastructure will reduce the skills mismatch. So that's kind of what's weaving through this policy report, and I'm closing with that. Thank you very much. I'm handing over to my colleague Michael for the next presentation.
Thank you very much. So to introduce what I'm going to present, I'm going to paraphrase Alan Greenspan, who said, uncertainty is not just an important feature of the macroeconomy, but actually it's the defining characteristic of that environment. And increasingly, myself and many others have been working on issues related to the macroeconomics of uncertainty. And I think there's two important issues that have come out of that growing literature. The first is the acknowledgement that there is a macroeconomic effect from uncertainty. So I think the sort of most famous proponent of this is Nick Bloom. And the second lesson is that some of the uncertainty that affects the macroeconomy is actually policy-induced. So policy is a very unusual thing in that it not only reacts to the uncertainty, but it is also a cause of that uncertainty. And the chapter in the book, in the report that goes by the title, The Macroeconomics of Uncertainty, is a chapter where I sort of present some of the reasons why increasingly macroeconomists think there are these effects and what it means for policy. And this is all very sort of important stuff right now. I mean, there in the last week have been some big headlines. Of course, the Nissan decision to produce the X-Trail in Japan. It's not purely related to Brexit uncertainty, but they did cite Brexit uncertainty as one of the contributing factors. And it's not just the sort of big headline grabbers that have been thinking about this. If you look at surveys of small and medium enterprises, they're increasingly talking about this. The Bank of England today referred to the intensification of Brexit concerns. And I think the reason for that is sort of obvious. I mean, we are in the process of leaving the EU. We are not far from March 29th. There are a lot of details still to be worked out about the transition agreement, which will determine the state of affairs for the next 1 to 3 years, depending on your point of view of the agreement. And there's even more details to be worked out about the sort of longer-term, more permanent arrangement for trading and other relationship with the EU. You can actually also see some of this weakness of investment in the aggregate numbers. We are currently at a time where in the last year unemployment has fallen from 5% to 4%. Indicating that there's increasingly not much slack left in the UK economy. Monetary and financial conditions remain pretty accommodative, and yet since 2016, investment in the UK has remained almost flat, and in the last 3 quarters it has fallen, and it is, I think, the first time it has fallen for 3 consecutive quarters since the financial crisis. It's not falling by any way the same magnitude, but it's still not increasing. Interestingly, the next ONS release with the data on that is on the 29th of the 3rd, 2019, so that should be a fun day. So why would it matter? Well, it's sort of one easy way to think about why it matters is to think about firms and investment. And the quickest way to get into this literature is to realize that firms are not making a decision, invest now or never. It's usually invest now or later. And in a world of uncertainty, there is what's called the option value to waiting. When things become more uncertainty, rather than going into an investment that might have some costs or it may have an irreversibility to it, you wait. And so That applies both to investment in physical capital, decisions about investing in the labour force, including things like training, and also things related to research and development, introduction of new product lines, introduction of new processes for production or for sales or whatever. And actually it becomes even more difficult because when we think about international firms, they're usually actually making the decision, invest now in location A, now in location B, or somewhere else in the future. And the difficulty with that is, if they make a decision to invest in a less uncertain place, that is not a decision that will they can come back to in reverse. The investment has already been made elsewhere. It's not just businesses that are affected, but also through the financial markets. There's another knock-on effect onto firms. In a world of heightened uncertainty, financial instruments build in risk premia, and these risk premia are such that they make the cost of borrowing bigger. They can affect particularly firms that are small or medium-sized, and especially those that are already near their constraints, particularly badly. And then finally, households. So this is actually many years ago, how I got into this literature was looking at the reaction of households to policy uncertainty. And you do see that households react to policy uncertainty by saving more. And you might think, well, saving would feed in then to investment, but actually in uncertain times, it typically doesn't translate into domestic investment. It will either be channeled through the international capital markets to other countries, or it simply builds up in the reserves of banks waiting for more certain times. So what does it all mean? Well, I take two lessons from this. One is a general lesson for economists. I have to say, I think economists are still learning to communicate uncertainty. And I mean academic economists, I mean policy economists, actually I even mean politicians. I think we still have a lot to do. Like I say, most uncertainty will exist at some point. There will be uncertainty. We won't get rid of all of it. And yet often we don't talk about it. We don't couch our discussions of policy choices with a lot of the uncertainty that we know is there. Now, part of that's driven by what people want. I mean, I just love the Lyndon Johnson quote. Ranges are for cattle, give me a number. But as soon as we do give a number, or economists, even when we give ranges, there's usually a number within that range that becomes the focal point. And that focal point then becomes almost a stick which to beat us when it turns out we are inevitably wrong. The fact that your forecast will be wrong is not, in my opinion, a reason not to forecast. But equally, when we talk to the general public, it's very difficult to communicate that uncertainty. So I've been working a lot, even not on fiscal side, but on the monetary policy side, about how to communicate monetary policy with the public. And it's very difficult to communicate the uncertainty. If you come across too sure, and then you reverse your decision, they're going to think you're less credible. But if you make it seem too simple, they're going to think, why aren't you doing what you should? So there's a difficult balance, and I think there's definitely more we can do there. The second lesson for policymakers is, given that some of the uncertainty the world faces, and that seems to have these heightened uncertainty has negative effects on the economy, and that these effects can become quite entrenched and quite prolonged in their effects, while we can't eliminate all the uncertainty, it should certainly be policymakers' objective to, where possible, mitigate and minimize the amount of policy uncertainty they create. I'm sure our friends who are here from the Treasury will know how happy their politicians were at the result that the businesses that they serve were happy when decisions were made about keeping corporate tax rates and things constant for long periods of time. These are very popular, actually, amongst businesses. We can certainly go further, and there's a lot to do. And of course, I'm not suggesting that we will ever live in a world of no uncertainty, but let's do our best to minimize it. At that, I shall stop that whirlwind tour of uncertainty and macroeconomics, and I shall hand over to Claire.
Thanks, Michael. I'm Claire Crawford. My chapter in the report was all about productivity and skills and how family background might play a role in that. So I guess the starting point for this is something that has perhaps got a bit lost in the discussion about Brexit, particularly in the recent few months, but has certainly garnered a lot of attention over the last few years, and that's the fact that there is a so-called productivity crisis in the UK. What do we mean by that? Well, we mean that productivity per hour, output per hour, is much lower in the UK than it is in other developed economies, about 16% lower than the G7 average, according to the Office for National Statistics a couple of years ago. Why are skills relevant to this? Well, of course, having a skilled workforce is going to be one of the important routes through which we might be able to improve our labour productivity. Perhaps too low a level of skills in the workforce might be a potentially contributing factor at the moment. Now, of course, in order to think about how to increase productivity in future, we need to be able to predict which types of skills are going to be of most value in the future. That's a pretty hard job to do. But I think we can be fairly certain that a kind of good level of basic skills, basic literacy, numeracy, digital skills are probably going to be important. And it's probably also going to be important that people know how to learn new skills, so the ability to learn, if you like. And there's a couple of dimensions on which the UK doesn't look so great in some of those regards. So, for example, our levels of basic skills look particularly weak compared to competitors. So, for example, a relatively recent study by the OECD surveyed the skills of adults across OECD countries, and they also compared the skills levels of those of different generations, so those just about to enter the labour market or having just entered the labour market, those in the middle of their careers and those about to retire. And the UK stood out on one particular dimension, which was that it was the only country in the OECD where the generation who were about to retire had essentially the same levels of basic skills as the generation who were just coming into the labour market. So the skills levels of the workforce didn't look like they'd improved over time, in contrast to other countries where everybody had improved, essentially. The younger generation were coming in with higher levels of skills than those who were leaving. Now, that was partly because the older generation had quite good basic skills from a comparative perspective, but now the UK is looking rather weak on that front relative to others. And of course, that might be potentially bad news for future productivity if our basic skills are not increasing or perhaps not keeping pace with our competitors. The other dimension I mentioned, which might be a bit less obvious, I guess, is the link between family background and the skills that you acquire, or the education levels or the income levels that you go on to acquire. Now, another dimension in which the UK stands out is the link between the environment in which you grow up and the skills or income or education that you go on to attain in adulthood. We have a particularly strong link. Vera showed you some evidence of that, putting the UK kind of a bit more in the middle, but there are certainly dimensions on which the UK looks particularly unusual. So one from the same OECD study about basic skills suggests that young people with at least one parent educated to A-level or equivalent standard or above scored about 1 standard deviation higher in these basic skills tests than those who didn't have either parent educated to at least A-level standard. And that was a stronger link than in all but 2 other OECD countries. Now, that's of course thinking about skills at the relatively lower end of the distribution. It's also true that the skills or opportunities that children have to acquire skills are also strongly socially graded at the top of the distribution. So, for example, children from the richest fifth of families are about 8 times more likely to be able to access a grammar school or to go to one of a group of about 40 high-status universities in the UK than those from the poorest fifth of families. And I think there are reasons to want to address this, not only for equity reasons, to kind of address potential social injustices, but also for these efficiency reasons related to productivity. If we're not identifying talent wherever it resides, then we're not necessarily going to be kind of harnessing the full capability of the workforce in driving forward productivity. So what is the state of play on these things? Presumably these are kind of not new facts, if you like. We've known that there are these very large gaps in outcomes and opportunities for a long time. Recent progress has been made. So, for example, there are many more people from more deprived backgrounds going to university now than there were even a decade ago. So about a 10 percentage point increase in the proportion of those from the poorest fifth of family, the areas with the lowest participation rates compared to a decade ago. And the proportion going to this group of relatively higher status or higher tariff institutions has also risen. But it remains really low. It's only about 3.5% if you look across a cohort of young people who are making it to one of those institutions. And although the relative chances that you go compared to someone from a richer background have improved, maybe you were 8 times less likely to go 10 years ago, now you're 5 times less likely, but the absolute gap has increased. So the proportion of the cohort of young people who are going to those institutions has grown faster amongst the richest than amongst the poorest over this period. So the absolute gap has widened. And I guess importantly, when we're thinking about the importance of education, it's not whether you've entered a university, but whether you've completed your degree and whether you've got a reasonably good degree class that seems to matter in the labour market. And we've also seen that dropout rates have risen, particularly those from lower participation neighbourhoods, and there are still big differences in degree attainment, of course, as there are along other dimensions, including ethnicity. So there's clearly more that we need to do to try and reduce these gaps. Now, we know that in particular, when we're thinking about access to universities and different types of universities, how well children are doing at the end of their secondary school careers are particularly important. So GCSE scores in particular, and also A-levels, are really important drivers of those gaps that we see. In fact, some of the research I've been involved with shows that if you control for a rich set of GCSE qualifications, including the subjects that people take and the grades that they attain, the gap between the richest and poorest fifth actually disappears. So it's suggesting that the entirety of that gap is being channeled through the importance of GCSE qualifications. So thanks to the Education Endowment Foundation, an organisation who've been endowed with money from the Department for Education to kind of run trials of interventions to try and work out what does improve the attainment of children, particularly from disadvantaged backgrounds. Thanks to their efforts, we know quite a lot more about what we should be doing from a policy perspective to really try and improve the attainment, particularly of those from poorer backgrounds. But we also know that attainment is not the whole story, particularly when we're thinking about access to these higher status institutions. You can't explain the whole of the gap using these GCSE or A-level scores. There remain small differences according to social background. And so there's clearly more that we need to do to think about what are the reasons behind that, why are young people not applying to those types of institutions, are there any kind of market failures that we need to be addressing. And I guess the other important point worth noting is even where we do know what we should be doing, we're not always putting it into practice as well as we should. The kind of debate about grammar schools and selective education is one of the very few, I think, where there is consensus among academics about what the evidence suggests, and that's not what we see being put into practice by policymakers necessarily. Now, of course, as I mentioned, there are these very large gaps and we should absolutely be trying to eliminate them. But of course, these kind of elite institutions, grammar schools, the highest status 40 universities, are only ever catering for a small minority. No more than about 10% of the population accesses those types of institutions. So we're also going to need to focus on improving the skills of those who don't go to those types of places. So, of course, the basic skills points that we discussed at the beginning are absolutely crucial. We can't have children leaving school not being able to read and write properly. That should be taken as a given. I think also importantly, we need to invest in our further education institutions. So they have been kind of left behind a little bit, certainly from a funding perspective over the last 10 years or so. Perhaps the review that will be coming out shortly will seek to address some of those inequities, but I think certainly greater investment in further education, better signposting of the routes that young people should follow through the vocational system, and also making sure that it's an attractive opportunity for all children, not just as a kind of fallback for those who don't make it to university, are all really important. And that's all because we know that human capital is a really important driver of productivity. So we really need to make sure that everybody is making the most of what they've got, taking all the opportunities that are available, and hopefully increasing productivity in future. Thanks.
I will now stand here and try and ad-lib while our next panellists and participants make the way, long journey up to the stage. Obviously thank all of our presenters. You may possibly have been here under the apprehension that we would also be hearing from Anne McElvoy of The Economist this evening. Unfortunately, Anne has been detained committing an act of journalism somewhere, for which she apologises. So, but Vicky, Torsten and Emma have promised to talk for even longer to fill up that gap. Small point of housekeeping before I hand over to Emran, who will take over the chairing of proceedings. Whenever our august chairman decides to call a halt to proceedings, we have a room downstairs. I think it's the Marble Hall, in best humble fashion. The Marble Hall, where you'll find drinks, refreshments, other treats for anybody who wants to stay and talk about the things we've heard. With that, I will go away and let Emran take over. Thank you.
Thank you, James. So I'm Imran Mia, as James said, a former director of the Social Market Foundation. I chaired the last time we launched a CAGE report, and it's great to be back to launch the next one. I've since gone back to being a civil servant, so I'll have to be more careful about what I say this evening. Especially on some of the topics that the panelists have raised. I work at the Department for Education, so I'm dying to leap in on some of the points from Claire's presentation, but I will resist. And then alongside me on the panel, two former bureaucrats.
Speak for yourself.
And I think Vicky's going to speak first, and then Torsten. I think we'll give them loosely 5 minutes each to speak. Of course, our panelists already have ranged quite far and wide. I expect the panelists who are about to speak will also range far and wide. And so then I think we'll bring it to you to instill some discipline into the conversation and bring us back to some common themes. So let's see if we can do that. So Vicky, over to you.
Thank you. I have to say we hadn't quite arranged the order at all, but I'm delighted to be the first to be speaking on this. And indeed, you're quite right. What I would like to touch on a wider issue. And I think there is a link between the presentations we just heard. And that link is really Brexit, which we can't avoid. There's an awful lot in the book you've got about Brexit here. And that's the most important issue that's worrying us at present. And all those things touch on it because, of course, what we do in terms of economic policy is going to be very important in the way in which we survive what's happening right now. So we were looking first at welfare, which I found really, really fascinating. Because, of course, I saw also what it said about places like Greece, which is where I come from. It's interesting that during the Brexit campaign, the amount of money that was being spent on welfare in the EU as a whole was used by the Brexiteers to argue that we should have absolutely nothing to do with that region, because although it only represented something like 7% of the population of the world, 25% of its GDP, it spent 50% of all the welfare spending in that region. I used to think that was brilliant. We all want to imitate that. And I was thinking of Greece, which of course it looked as if it was spending quite a lot, but in 2015, I think the figures were there. 2015, Greece had already lost a huge amount of its GDP. It lost 25% of its GDP in just a few years since the financial crisis. And of course, you can't actually keep up. If your GDP goes down, the percentage you're spending on welfare, I mean, first of all, has to go up. I mean, the actual amount has to go up. In reality, it hardly did go up, and there is hardly any unemployment benefit. It's just a share, because GDP was falling so substantially. So we have to be very, very careful when we make any comparators and see whether welfare spending actually has any impact on poverty levels and relative poverty levels. And of course, the poverty levels there were rising and have been rising. There is a serious humanitarian crisis there. So just a warning about this. And then the link to what happened during the years that led to the final referendum and the vote. show very clearly that actually what was being spent by social services and local authorities in the various regions, and there is a very good study looking at that in the report that we've just got, was absolutely critical in encouraging the people in those regions that had the biggest cuts and the greatest austerity to vote for UKIP first and then for Leave. And of course, during that period, there were some very substantial cuts in local authority spending, which of course were going mostly to social services, which basically were cut and cut at a time when immigration in some of those regions was rising quite significantly with the push on social services at the time, and those were being cut, or they were kept the same in real terms, like the National Health Service, and yet demand was increasing. So there are some links, and so welfare is actually more significant in terms of how it's spent, if you want to think of welfare in a wider context, than just looking at what it does to poverty levels, and also just comparing it, as I said before, with the actual levels that are achieved in each country and the percentage that are spent. It doesn't actually give us a proper analysis, I think, of what's actually happening. So that's the first one. On the second one, on uncertainty, absolutely. It's a very good analysis of what happens if you decide not to perhaps invest. But it links, interestingly enough, with the productivity one. Because actually what firms did at the time of uncertainty, and that also explains what's happened to employment, which has been so high. They decided not to invest, but of course there was still demand in the economy. Remember, if we look at 2016 and 2017, I'm now talking about since the referendum, because this is a Brexit analysis of sorts, companies decided not to invest, and that's got slightly worse because uncertainty has increased recently. But that investment, just as we heard, also doesn't happen in areas like training. But what they did was just hire more people to meet that demand. 2016, 2017 had seen a very substantial improvement in world trade. It's gone downhill since. But that demand, and Europe was doing rather well, to which we do, whether we like it or not, still sell 45%. In fact, the latest figures are even higher in terms of what we sell to the EU. But the EU was doing well, and we were selling quite well. So there was demand in the economy in the UK, mainly because the Bank of England had put so much liquidity into the system, but also because the world economy was growing, and we were selling rather a lot to them. Now, that demand was met mainly by just hiring more people. And hiring more people without necessarily training them, so the skills weren't necessarily being developed, without necessarily doing anything very innovative. So actually, during that period, our productivity gap with the rest of the world, with our main competitors, increased even more. And that was the real problem. But I have a slight concern about the skill levels more generally, because strangely, because of immigration, even though a lot of the new jobs were not very high-skilled jobs, the actual skills going into these jobs in every sector went up during that period, which in itself is good news. The only problem is you don't actually use these people very productively, but although I'm sure, the way in which coffee is served these days is much better than was the case before. So there is actually a service productivity improvement that's taken place. And the people who serve you are probably engineers or nuclear physicists from Greece or somewhere. Actually, hardly any Greeks, but the rest of the Europeans. So that is basically what happens. So productivity has suffered as a result of the uncertainty, which has led to that type of behavior. And unfortunately, during that period, not only did we lose in relation to productivity, we also lost very significantly in terms of growth. The estimates are, and it's not just the Centre for European Reform, it's lots of others, including the Bank of England, that we've already lost to 2.5% of GDP, which is major, actually. And that will never be recovered. So when we are looking at where we stand in relation to the rest of the world, we are in a serious and competitive position. Whatever happens with Brexit, even if it gets reversed, that cost is probably never going to be recovered. So the final one on productivity and using skills, which I already sort of touched on, just one little comment, which for me is quite significant. There's another study, which in this report, which talks about women, and the thing that I welcome is that finally we talk about women and their contribution and being allowed to move into higher positions and so on, from the point of view of improving productivity. And it is because they will be there, they'll be skilled, they'll be trained, they'll be skilled, they'll be able to contribute sort of an awful lot more. But I did have the impression that if you look at where women are now, and the entry level of women in work and so on, actually, certainly in relation to women, we have a force which is considerably better educated than the previous generations. So I'm just slightly sort of questioning, are we just talking about the people who just have the basic skills in that report, or are we talking overall in terms of the skill level? Because I had been certainly under the impression that one of the reasons why women have done slightly better is because they are hugely better educated now than was the case for the mothers and the grandmothers before them. And I'll stop here. Thank you.
Thank you, Vicky. Thorsten.
Thank you very much, Imran. I thought first I should say it's good on Social Market Foundation, Warwick, Cage and others, because it shows that it's been a pretty bad decade for lots of economists, and you're still prepared to come into Westminster, so that is good. I can remember in the financial crisis, bankers sneaking in the back entrance to the Treasury just opposite us, worried that they were going to get their heads kicked in. The anger didn't come in time for the kicking to occur. But anyway, there's lots in this report. I mean, there's a lot, and there's lots of it, if you've got your copies, there's lots to agree with. There's lots of things, if anyone agrees with all of it, there's probably something wrong with you. But rather than picking through kind of the individual bits I agree or don't with, I thought it would be more useful. What's good about it is that it asks a very big question, which is what is the job of economic policymakers a decade after upheaval? What are the questions that we should even be asking, and what are the answers, and which ones do we have answers to? And those are big questions, and I think we focus too much sometimes on, and sometimes the role of academics in helping policymakers is not, sometimes people think about it as, oh, they're the experts, so they should come along and tell us the technical answer to question X, and we all know what question X is. We know what the question is, and they're going to come and tell us the answer. That's slightly how the debate often goes, and that's important sometimes. Like, there's lots of things I would like to know the technical answer to. The EF do lots of that in education policy. I really value that. That's a good thing, but that is definitely not all that they're for. And one of the things we should all have learned after the last decade is that we need to ask the right questions. Now, forward to this is by Gus O'Donnell, who was the Cabinet Secretary, was also the head of the Treasury Civil Service at the beginning of this century. None of you will remember it, I don't think, but he co-edited 2 chunky books with academics in them. There were even academics in them at the beginning of this century. One was the Silver Book, and one was the Gold Book. And does anyone remember what I'm talking about? One man does. Thank God someone's here. That's fine. Right. So there was 2 books, and one book said we have got the answer to microeconomic policy making. Yeah. 20 chapters with the answer, largely written by kind of our predecessors of people on this stage, but kind of people around the New Labour government and the economic establishment. And the second book was we've solved macroeconomic policy making. So we'd done it all basically in these 2 books. It was all sorted. It is worth reading back through. One, because it will, for a number of ways. One, it will tell you it's kind of funny in retrospect. It's quite slightly funny. The tone is really funny. Okay, and I was involved in lots of this. I'm taking my share of responsibility for this, but it is confident. It is Britain leading the world, telling the rest of the world how to do economic policy making. We know the right questions, none of this nonsense. We'll do macro policy with the Bank of England doing stabilisation, and the Treasury will deal with fiscal sustainability. Everything else is nonsense. And on the micro side, so long as we sort out the 5 drivers of growth skills, that will sort most other things out. I'm being slightly unfair, but that's broadly what it says. Now, one of the things that the experience you get around policymakers, economic policymakers in particular at the moment, is the opposite of that. There's the opposite of that feeling of confidence about what the questions are and what the answers are. And it is worth, to be fair to them, why is that? And the answer is because it is incredibly dislocating, emotionally, intellectually, as a human being, to have all of the chunks of what you thought you knew were like the simple things to do thrown up in the air at once. So I'll give you some examples. And to think about it as a growth model for the country, okay? Lots of the chunks of what we thought was Britain's growth model have been thrown up in the air at once. And unless you can and by the way, this does matter. Countries that don't have a growth model that there is some consensus about, They do have economic policies, but they don't have an economic policy, and they tend not to do very well because they chop and change all the time. They're very reactive. They don't know what they're trying to achieve. Like, it is a problem. But for example, we thought that a large domestic market, the EU, was how we competed at scale in a globalized economy while protecting our welfare state. Like, that wasn't what Margaret Thatcher said, obviously with the welfare state bit, but the common market was the supply side reform that was done to the British economy. That was like core part of the model, even if not articulated as such. It's gone. The city meant we definitely had a comparative advantage in a scary globalizing world where big developed countries weren't going to be delivering manufacturing in the way we used to do. The financial crisis blew that up, even if nothing else was going to do that. Thirdly, all of that microeconomics that said education will definitely sort out a lot of the other problems for us, don't you worry, the economics of place has definitely, over the last decade, made us rethink that. It is not enough to turn up in Blackpool and sort schools out a bit. That is not enough. This is harder. Economic geography is harder. It poses much bigger challenges to developed countries than we thought. And we've learned that inequality, however relaxed you are about the economics of inequality, that it can do things to your politics. And so even if you don't care about it for straightforward fairness reasons or for kind of the effect it has on your economy, it will do things to your politics that could be much bigger than you think. And I think and now we're much more, I think, accepting that the level's an issue. So that was the model being blown up. Then the question is, where are we now in terms of putting it back together? What are the questions we're answering? And in some ways, as we're thinking, we're a long way from 2010. So some of the ways you think about it is the financial crisis happened. So maybe in 2010 we were asking the questions that you would ask in a post-financial crisis world. And that is definitely not true. After the financial crisis, we thought the rethinking meant, it turns out financial stability does require much more heavily capitalized banks than we thought. I mean, they learned that lesson because we just gave them some capital, or you all gave them some capital as taxpayers. Thank you very much. And that we've got a challenge about stopping that being undone as the cycle reverses, but we've cracked the answer to that new question, embarrassing as it was. And then we thought we had a question which is, how do you stabilise economy? Well, we used to think the Bank of England would do that, and we can invent some new tools for the Bank of England, QE. We can invent it very fast, it turns out, when we have to, and we can do a lot of it. But then we didn't, and then even though our book said we wouldn't do it, we will use fiscal policy if your crisis is big enough. We thought, right, so okay, we've answered that new question that the new world has thrown at us, so we've solved those two. That's done. Now, again, if you think we looked complacent in 2000, now, looking back, we were, to a different degree and in different ways, complacent in 2010. Because those, it turns out, were not the only things that needed rethinking post the financial crisis. So there's some new, now we are asking new questions, so I'll just reflect on a few of these and then shut up. So on the labour market, we're asking, so none of us thought what has happened to the labour market in the last 10 years could have happened. It's not that we didn't think it would happen, it's that we didn't think it could happen. We did not think that you could increase employment by 3% from where we were pre-crisis to today. Forget the dip, the levels increase. Why is employment higher today than it was then? Why did employment not rise in the way we thought it would? In the Treasury during the financial crisis, every scary planning meeting about what the hell are we going to do, this recession is huge, bigger than any recession anyone in the building had ever seen. Unemployment will go over 3 million. What is the response to that? That was what the planning discussions were about. It never got near 3 million. Okay? We never clocked why it wouldn't get near 3 million. And I think even today, when I did an event recently with the employment minister about what's happened to full employment. It's interesting. You actually say to them, people are good at talking about describing what's happened. Say to them, why has it happened? Why is employment so high? And they might say to you, it's a bit about the flexible labour market. It's nonsense. It's not a more flexible labour market now than it was in 2008. It's probably slightly less flexible. It's just nonsense. Can't be that. Like, what are the reasons? And I'm not going to go into my particular answer to that question, but these are big questions, and they really matter. I'll give you another reason why it matters. If another shock happens tomorrow, and the exchange rate doesn't fall because Britain is not particularly exposed to the shock, we will not see that same thing happen again. Policymakers assume the next crisis will be the same as the last crisis. It will be wages bad, employment good. That is not true. That will only be true if the exchange rate is able to go through the floor again, prices are able to rise, pushing down real wages. Forcing ourselves to say, how does our economy work? What will it do next time? And is policy ready for that? We are not remotely I mean, we would literally have to shut down huge sections of DWP and send everybody back out into the fields to run job centres in the way that we used to run job centres in the 1990s. There's no planning for that at all. That wasn't meant to sound as Cambodian as it did, but you got the point. Now, the quality of jobs. So there is now a huge debate. People are in this country asking the question, are the quality of jobs good enough, even though there's huge numbers of them? Yeah? And that is a good question to be answering. Some of that is because there's new questions to ask. Why is self-employment in this country so much higher than elsewhere? And by the way, it is nothing to do with technology. Almost nothing. There's a long-term trend that's slow, and partly that, it's our tax system. Everyone's like every country in the world and is seeing this huge rise in self-employment. It's just nonsense. Since 2000s, loads of countries haven't seen big rise in self-employment. And why not? Because their tax systems don't pay you through the nose to be self-employed. And we're asking that question rather than just patting ourselves on the back and saying, oh, well done, getting your self-employment rate up, which is what was happening in the 2000s. 0 hours contracts, feature of our labour market pre-crisis, a bigger feature now, but now actually being discussed about what we do about them. So there's some areas where you've seen progress. The question should have been asked before the financial crisis and has now been put into relief. Low pay. Again, low pay questions were being asked about low pay before the crisis. It has not got, low pay itself has not got massively worse post-crisis. Actually, it's falling right now. But pay for everybody has been crap post the crisis. It's not really an inequality thing. It's everyone. Bad for the rich, bad for the middle, bad for the bottom. And so people are now, and then people tend to start talking about things when they affect the middle. So like, why do we talk about home ownership today? Because home ownership, when did home ownership amongst young people start falling in this country? Come on, someone. No? Put in? 2002. That is exactly when home ownership for the country as a whole starts falling. So it's pretty good. It starts falling in 1989. And no one notices for 15 years because it's the poor who are seeing their home ownership rates fall. And we start noticing as soon as the aggregate figures show it, and middle-class journalists, sorry, James, start seeing their kids not getting homes. And the same is true of pay. Why are we talking about low pay? Because everyone's pay has been stuffed. So, right, productivity, we are all talking about it. It's good that we're talking about it. The financial crisis, there's 2 productivity crises going on. Why is Britain such a turkey after the financial crisis? And then why is Britain's level of productivity so different? And those are different questions and they have different answers, and segmenting them would be a good idea. And academics can definitely help politicians think through this. Right, then there's a chunk of questions that have got nothing to do with the financial crisis and Brexit has just put on the table. I hope I'm creating some emotional dissonance for you, because we haven't got answers to a lot of these questions. So Brexit, we kind of think about it as, it obviously asks us some questions. Yeah? The book deals really well with some of the questions about the cause of the vote. But forget that for policymakers right now. I mean, I'm in favour of that, we've written lots about that, but it asks us really basic questions. What is the relationship this country wants with some of its bigger trading partners? And we literally took that as a given for the last 30 years, and we do not have an answer to that. The policy-making community does not know what its answer is. Some of them do know the difference between a customs union and a free trade agreement. Some. Lots don't. Lots don't. But what you actually want is almost every conversation I have with policymakers is about the tactics of this Brexit nonsense. Almost none of it is about what the actual endpoint we desire as a country is. That is a disgrace. But it also triggers loads of other questions. We haven't had a migration policy ourselves for years. What's the migration policy we want to have? What things matter about that policy? At the moment, we seem to be proposing 1-year temporary visas for low-paid workers. That is a disaster, both economically and for integration. I mean, no access for low-paid workers, in my view, is better than that. That's like the worst of all worlds. Bad for integration, bad for the economy. You'd better not have access at all. But that's because we don't know what it is we want. And then lastly, I was going to list some questions we're not asking, but we should be asking. Right, 1, how is economic change in Britain different today than it was in the past? Because if I read one more article telling me that the problem about economic change is where's the next Cleveland, where's the next Glasgow shipyards closing, that is not what economic change looks like in 21st century Britain. It looks like the retail sector, it looks like diffused economies. That is where we need the answers. Generational strains, what is our offer to young people today? Low productivity does not affect everybody equally. Yeah. And this is particularly important because why does democracy and capitalism work well together? Because if the people doing the working they're the ones that, who does productivity affect? The ones doing the working then. Young people the most. And if you don't have faster productivity growth, you can have bits of your democracy, the old, voting for stuff that's bad for productivity. And the people that you want supporting democracy, the young, the working age population, increasingly, I think we're not remotely at the races, and it's not just about house prices, although housing is a lot of it, and wealth. We have not even started on this. Wealth has grown quicker than income for the last 30 years, twice as fast. And this is not like, and this is mainly about house prices, but it's not just. All assets are just more compared to the size of your income. It's not, and I'm not making an inequality point. It's just literally the ratio of wealth to income. And the reason this matters is because if your wealth grows faster than your income, you cannot earn your way to being rich in a country like that. It's a fundamentally changed country. You can inherit it, you can marry it. Anyone not married yet? It's not too late. You've got to marry someone rich. You can get divorced and try again, but divorce is so expensive it might not work. But I'm not joking about this. In 20 years, we're going to look back, look at those figures. Inheritance has doubled in the last 20 years. They'll double in the next 20. And we are not in the races about what that will do to our economy. So overall, then, conclusion, I will finish, I promise. The question is, this question is the same as the old question, which is how do we deliver rising living standards for the bulk of the population, and how does that then get us back into a virtuous circle of capitalism and democracy underpinning themselves? The good news is we're a lot less cocky. Like, those books wouldn't be written today, I don't think. There's a lot more kind of self-reflection, there's a lot less shiny covers in general. The bad news is we haven't got answers to a lot of those questions, which is why we can get the academics at SMF to tell us the answer.
Thank you, Torsten. Okay, now it's over to you. Typically, what we try and do at a panel discussion like this is have some of the answers up here on the panel. That hasn't really been the case today. I think this has more been about asking some of the questions, but maybe that's a reflection of the fact that it has been a decade of upheaval, and a lot of these issues are up in the air. A lot of these questions do need answering. So look, it's over to you. I suppose you could have a go at providing some of the answers, or you could provide some questions, and then I'll try and get these guys to finally start providing some answers. So who wants to come in? I'll take 2 or 3. I think at the start of your remarks, kind of just say a little bit about who you are, and then kind of ask your question. So go ahead.
Leon Wall from Revenue Investors. My question is, we just heard the UK is suffering from low skill sets and low productivity compared to many countries. I think you said either G7 countries. And my question would be, I've just seen on BBC News, that a certain party is proposing a £10 national living wage by next year. How would that help or not help in terms of encouraging the labour force to increase their skill set in order to gain employment?
Okay, thank you. Who else? Yeah, this question over here.
I'd like to supplement that because I work for the Research and Innovation Group, and I like to keep things in the wage. And we believe that it's a disgrace in the country has a wage where workers are forced to be assembled.
I think that the microphone has actually been turned off when you pick up. Sorry. Or not working at all. Well, I'll take it back and you can share. Sorry.
So how do we get policymakers to understand that the wrongness of someone having to be dependent on the state for if they're working a full-time week?
Okay, thank you. Look, let me put those to the panel because they're quite related, I think. So the question around kind of link between, will driving up wages through wage regulation produce a positive effect on productivity, or what kind of effect do we think it will produce? And then I think kind of you're asking for reflections from the panel on this issue around kind of people, despite being in work, nevertheless experiencing poverty. Who from the panel would like to have a go at those two, I think, slightly linked questions?
Yeah, I can say something.
Claire? Yeah. And then I think that I'll come to you as well, Torsten.
So yeah, interesting questions, thank you. I guess with both the minimum wage and with in-work support, there are potentially kind of two motives, conflicting perhaps. So one is clearly about living standards. We want people to have a reasonable degree of comfort in terms of their living standards, particularly if they're in work. I agree, it's not ideal that we have a system which is kind of delivering a lot of the living standards that seem to, that people need through state support. In terms of the question about whether kind of raising the minimum wage would lead to incentives to kind of get more training, I mean, I guess we can think of the investments that people are making in skills as both coming through their lives before they enter work and then what happens once they actually get into work. I mean, I guess one might expect that if the lowest paid jobs are rewarded more highly, that might reduce the incentives for people to invest in their skills because there isn't such a need for them to work their way up the ladder or to be able to enter higher up if they are able to secure a reasonable living standard with a lower wage rate. But on the other hand, perhaps it affords people the security through which they could then decide to invest in some education later on in their lives. Perhaps it might reduce employers' incentives to offer training if they're having to offer higher wages instead. I think there's a whole lot of kind of conflicting incentives that could be at play there. It's certainly not certainly not the kind of obvious policy that you would choose as the way to boost skills, kind of most directly, if you like. I don't know whether anyone else wants to say anything in addition.
Okay. Torsten and then Vicky.
I mean, taking the question together, so there is obviously an active debate about the relative roles of minimum wages and in-work support in both raising living standards, giving you the best work incentive mix, if I'm honest, and also supporting. The thing to always remember is families are very different. And so it is my view is the debate that says, should you have more minimum wage or should you have more tax credits or universal credit, I think is a very dangerous way of posing it, because that is not how the labour market and families actually work. I'll give you an example. An increase in the minimum wage does not particularly increase the incomes of families right at the bottom, which is what everyone assumes it does. Because lots of the people on the minimum wage are in households that are not the lowest incomes. They're second earners in middle-income families. In fact, it has a broad effect across the bottom kind of 60%, 70% of households. The biggest rises are probably in the kind of third, fourth decile. Whereas the benefit system, most of it, not all of it, but the benefit system mainly is driven by household income levels, and so is directly targeted at the bottom for 3 deciles of the population. And so you're going to want both. You're going to want both, and I think we should not be. And I also just caution, if you want lower poverty rates in this country, then you need the benefit system to do that. You are not going to lift children out of poverty. And remember, poverty rates in the UK have been going up slowly in the last few years, look like to us on our projections to be going up quite fast in the next few years. If you want those things not to happen, you cannot do that through labour income. I think we should be really careful about that. It's not going to happen. It'll only happen in the short term by using the benefit system to do it. Now, I would also like us to improve our pay at the bottom, actually not just through the minimum wage, but through progression, through allowing hours. People have the choice to do the hours they want to work, not be forced onto short-hour contracts. There's lots of other things you can do, but be really cautious about people taking black and white binary choices between is it the minimum wage or is it tax credits. If you actually care about both dignity in work and poverty, you need both.
Vicky.
Well, I think I agree with that, but it's really quite interesting because, again, looking at international comparisons, since we saw the slides there before, in places like Greece that cut minimum wage, it was completely disastrous in terms of the economy. But populism came as a result. But interestingly enough, places like Germany didn't have a minimum wage until very recently. And again, of course, there had been this serious concern there too that the share that was going to income was actually not rising significantly, despite the fact the economy was doing sort of reasonably well. So it has been not just here, but it's been happening everywhere, this issue of wealth versus incomes, which completely against what every economist had thought. We all thought this was going to be an amazing knowledge economy from here on, and individuals were going to be, therefore, necessarily having a bigger share of the overall cake, which simply has not been the case anywhere, really, across the world. So that is that is an issue that needs to be thought about. And we all thought originally, when the minimum wage was first introduced, that was going to be disastrous. And we didn't all think, but actually there was quite a lot of work done to ensure that it worked smoothly, because we had actually given the reasonable advice to ministers on this. And it's worked reasonably well. But there's no doubt that as an economy, there are various sectors where margins are very, very low right now, such as retail, that was mentioned by Torsten, where in fact, there are hundreds of thousands of jobs that are disappearing, and anything you do, because the margins are so low, to raise that cost, clearly you affect what they do. But of course, what it does is it encourages automation and it encourages productivity. So we have to decide at some point what it is that we want to do as an economy. Do we want more labour? Do we want a higher productivity? And it'd be nice to have both. And I think you, of course, can have both. Particularly in a situation where we already have quite high employment, and if you skill the people and are able then to charge perhaps something more at the end, that would be nice. But unfortunately, what is going on right now, just thinking about what type of policy are we going to be having in the future, we have actually squeezed people very significantly. We don't put sufficient value to things that people do. I don't quite know what's happening with our social welfare function. Maybe the Social Market Foundation can sort that out for us somehow. But we seem to put such little value to care workers and social workers and teachers and so on, and yet completely accept the sort of tens of millions that CEOs get right now in this environment. So there is something that needs to be rethought. Clearly, I'm not going to argue about whether the benefit system as against incomes is the thing that does it, but there is actually something about not relying on the benefit system in terms of self-confidence and believing that you can be independent and actually look after yourself. And of course, if you're faced with a type of government which actually believes in cutting it, then you're very vulnerable immediately. So I think actually minimum wage needs to be adjusted and needs to be adjusted upwards again, because we've seen that with the living wage calculations that actually in many cases it doesn't actually apply. But I did want to say something about employed and minimum wage. We seem to think this is actually quite good to have all these people who are self-employed. Of course, maybe the tax system has encouraged it. But in reality, when you look at what's happened to productivity over the last few years, certainly since the financial crisis and the huge increase in the numbers of people who are self-employed, and how do you actually calculate the amount of hours the number of hours that are being put into producing anything at all? It is my complete and utter belief that the majority of the self-employed increase that we have seen has also led to a reduction in our productivity, or certainly a slowdown in our productivity, because they were simply not being paid per hour the amount that you think they should have been paid. They work considerably longer and get paid a certain amount, which actually does not reflect what they do. So taking them away from normal work, putting them into self-employed, has actually contributed to the slowdown in productivity that we have seen.
Okay, let's take some more questions. I've seen 3 hands, so I'm going to take those in series. So gentleman here first.
Thanks very much. Don Cruikshank, who's been in and out of the policy formulation role for many decades. I'm struck by Torsten's addressing the Kantian question of what are the big questions. And a quick flip through the document, and it's been quick. Can I suggest 3 that are missing? One is there's very little mention of demography, the age structure of the population. Yes, it's doubtless covered on the side in the immigration section, but I haven't read it. And that just seems to me to be so
the
simple.
First.
The second one is the quality of our policymakers. The first
which you're about to say is uniformly
The first
excellent.
minister I came across was Keith Joseph. He's a towering intellect compared to what we have now. Now, why is the quality of our policymakers, both politicians and in the civil service, I might add, reduced so much over the last 3 or 4 decades? And then thirdly, the constitutional issues. We keep doing these comparisons with the OECD countries, and we do not recognize how centralized we are. How much is dictated from Whitehall, and how much of that is dictated by a few 30-year-olds sitting in the Treasury. It is just a dreadful situation that we've got ourselves into in terms of policy making.
Okay, so three
So
questions,
there's three big
to add
questions
to
which
the
are not
basket.
addressed
Yeah.
in the paper as far as I can,
Okay.
as far as I can
Thank
see.
you. And then over here.
Alistair Smith, University of Sussex. Just one and a half questions from me. For about 7 years after the financial crisis, we had a government whose constant mantra was its long-term economic plan. Presumably the panel think it's a good, I take the message, it's good to have a long-term economic plan. But the long-term economic plan focused on government debt and deficit, which I didn't hear any of you say is a high priority issue. So is part of the problem that we had a long-term economic plan that had a more or less irrelevant objective?
Okay, thank you. And then one right at the back. Seems to be only men asking questions.
Or men asking too many questions.
Yeah. Go ahead.
Hi, I'm Andy from the Centre for Progressive Policy. Torsten, I think you're absolutely right that we're not asking the right questions about our economy. But I wonder if also we're not measuring the right things. We're still a country that, above all else, prioritises GDP growth. It'd be really interesting to hear the panel's views on, the beyond GDP movement, and if we can do better than GDP as a measure of national economic progress.
Okay, thank you. Michael, can I come to you first on these? There's quite a few there, so you can take your pick.
With pleasure.
Yeah, go for it.
So I want to sort of mention, I'll try and jump in on three of them. So I really agree on the demography point, and it actually links to the second question. There is actually a chapter in there which I wrote about the, I don't think I would call it an irrelevant objective, but I would say the particular emphasis on debt and deficits is, in my view, misguided. And the link to demography is that we have these very short-term views of when we need to think about debt and demography. And there's two big elephants in the room about debt and deficits. And the two big elephants in the room for fiscal policy are, of course, climate change as a big risk and with potentially big implications for debt and deficits, and demography, which we know is happening. It's just happening, very predictably, but quite slowly. And so there are some very clear big questions that we need to be thinking about there that should really be, I think, at the sort of top of the list when you're thinking about budget priorities, and perhaps they do get coverage. And actually, in the paper, if anyone's interested, on those topics, because I haven't worked on those topics myself, but I reference there's a bunch of good stuff from the IFS where they've looked at exactly projections of these things. And if anyone is interested, the citations are in there, and I recommend you go to them. In terms of the broader definition, I'll touch on this and let others jump in then after. I recommend the last policy report, which was exactly on this topic, which was indeed suggesting that that there is a wider link to measures of things like welfare and happiness that is exactly covered. And it really is, it's a slightly different format of a report in that it's not a lot of chapters that are short, it's actually sort of bigger chapters, but there's some really excellent discussion in there. So I just want to advertise that if it didn't get coverage in here, it's because it really has had its own publication. So.
Okay. Anyone else from this side want to come in on those? Okay. Vicky and Torsten, I think I'll allow you in on one of those each. So okay. not on the whole panoply.
Okay, just on the GDP, I mean, of course, it makes a lot of sense. But in reality, if you don't have your GDP or you don't have your money, you can't do anything about all these inequalities and the concerns that we all have, frankly. And right now, with the measures we have, irrespective of whether you think they're any good or not, we have a fall in investment, assuming we calculate it correctly, and we have business optimism at the lowest in years, and consumer pessimism increasing very substantially, despite the fact we have this high employment we've just been talking about. That is probably because they're all being paid peanuts, and they're relying on the state, which is, of course, cutting and cutting. So, frankly, you can think of happiness as much as you like. You don't get happy people if they're not employed.
Okay, Thank you.
Well, in good jobs, if that.
Any other caveats? Or go on, since we're all on that topic. So we're actually publishing a report on well-being next week, but we're publishing it actually to help policymakers. So it's actually Gus O'Donnell, who wrote the intro to this, has spent the last kind of 10 years banging on about the well-being literature. There's only one half of the GDP debate, but there's the well-being side, then there's actually what are we calculating in the GDP figures. But let me keep it simple and focus on the well-being half. Which covers a lot of what Vicky's just said and shows, amongst other things, that having a job and decent income is quite good for your well-being. Who knew? But I'd say something more interesting on GDP. Let me say something about GDP per capita. Because GDP on its own is not a great measure of like what you're trying to achieve as a society. You just go and get loads of people and suddenly your GDP's up. On GDP per capita, I do worry. So there's lots of problems with it. Okay, I'm not defending like a made-up number. All our numbers are made up. This one's one of the winners. But when I hear people saying things like GDP growth doesn't mean anything because it doesn't feed through to pay and things, and that is a lot of that around at the moment. That is really dangerous. Okay, it's really dangerous. The reason pay is not growing in this country right now, it's not about inequality. It's not about like anything else clever. It is just we have not got enough productivity growth, and that is why our GDP per capita is not growing. And so we mustn't, in getting even ever better refined measures of GDP, looking at other measures of economic welfare, caring about well-being, we must never let the consent. I mean, I've heard politicians have sat next to me on panels and said, nowadays everything's changed. The way the economy works means that GDP does not feed through into pay, and that is a lie, and it's a really dangerous one. Because if you want to know how Britain can become an even more dangerous political and economic place, it's if we stop caring about that, start being like, oh, living standards aren't going to rise anyway. That is the way to a proper revolution.
Okay, I'm going to ask a question to our panelists on this side. So earlier on, Torsten talked about how before this decade of upheaval, there was a certain confidence about economics and about policymakers.
British policymaking. Yeah.
And kind of, I think my question to the economist to my right is, what's the critique of your, to the extent that you no longer feel that confidence, what's the critique of your work or your discipline that you spend the most time thinking about? I'm going to start with Vera.
Oh, God. I'm not really an economist. I am a political scientist by training. But so I think what comes out also in this policy report is really that, that before this decade of upheaval, or even 2 decades, you could almost call it, there was kind of consensus in economic policy making that was like, growth is the one thing that is important, right? And I'm citing also that, inequality was not something people thought about, and that as long as we, as globalization does its job, as long as we are reducing barriers to trade and investment and capital movements, that will increase overall GDP and everybody will be better off. But really, I guess the major issue is, as we see from the last decade, that this clearly generates winners and losers, and I think both economists as well as economic policymakers have not thought enough about how we can compensate the losers of these processes. I think that's one of the major things that also comes out in the Brexit vote and why people voted leave and so on.
Okay. Michael.
It's a really hard question. So I have nowhere to hide. I am a macroeconomist, and we're like the bottom of the pile amongst economists.
But that's the thing, right? You used to be top of the pile.
I know, yeah. So I guess the critique that I actually probably think most about, but in a very defensive way, is what I sort of alluded to. I mean, I spent 3 years working at the Bank of England as a forecaster. Forecasters are wrong. They know they're wrong. You know the second you finish your forecast that it will be wrong. And so the one I get very upset about is when people say, because you got something wrong, therefore I shouldn't have to listen to you. Nobody should have to listen to me in particular, or anyone in particular. but to suggest that the entire field brings nothing to the table because it's difficult to forecast the complex interaction of 65 million people and a lot of firms and very complex international supply chains and shocks from outside, shocks from within policy, and shocks from everything else that goes on. I just don't think is a reasonable critique. There are many reasons to not listen to macroeconomists. I just don't believe that that's one of them. The one thing that I think I have learned, I always knew that monetary policy, we don't know exactly how monetary policy works. We don't know exactly when its effects will be. We don't know exactly the effect that it will have on everything in the economy. But I remain convinced that we do understand that it generally works quite well. And if I had to rerun the crisis, I would again turn, as we ended up doing, and not just in the UK, but across the world. And I think monetary institutions have sort of shouldered a lot of the policy burden for keeping the world economy going. And so I've actually, if anything, become more confident in monetary policy. Even though we hit zero lower bounds and we gave them a whole bunch of tools that were very uncertain and some of them presumably didn't work, I remain quite confident about monetary policy. So that was almost a red rag to Torsten.
Claire, what's the critique of your work that you spend the most time thinking about?
Well, I jotted down the same thing as the point that Michael had made about the point that about forecasting. You know, we don't want, if you're in danger of saying something wrong, we don't want you to just stop saying anything altogether. I think that is a danger. That's not something I encounter a lot in my work. I'm a microeconomist focusing on kind of education and skills issues. In my work, I think kind of from a positive perspective, I think the work that the Education Endowment Foundation have been doing to kind of really try and nail down from a causal perspective what works to improve the attainment of children from disadvantaged backgrounds has changed a lot. I think the kind of potential danger there is actually they found out that quite a lot of things that we thought might be quite effective don't seem to work as well in practice as we might have predicted that they would. And I think the danger from learning from that is that people think, well, you haven't found the golden bullet, so we might as well stop investing in kind of that type of inquiry. I don't think we're at that point yet, but I think we certainly don't want to underestimate the kind of usefulness of null results, if you like. It's just as useful to find out what doesn't work before spending millions of pounds investing in it for children all across the country as it is to find out what does work. So we should all be kind of, I guess it's similar. We don't want to let not having found the answer yet stop us from trying to look for the answer.
Okay. Any more questions from the audience? Yes, there are. Go ahead.
So I was wondering how much you think maybe short-termism, an attitude of short-termism has actually had an effect on the past 10 years. I feel like often recently as well, politicians just like to put a sticking plaster on stuff. Dr. Crawford, you just discussed about finding out what works and what doesn't. And we were talking about raising the minimum wage or relying more on benefits. I feel even, okay, let's raise the minimum wage, but then are we thinking, why do we need to do that? And are we addressing those concerns? And do you find it, as academics, you might be looking at those concerns, but do you feel you're being listened to? Because I feel in the work that I'm in, there's a particular issue, and with the government have just put a sticking, it's too late. It starts at the bottom, when people, the culture, but instead they're only addressing it once the problem's already begun.
Okay.
So I'm just wondering, yeah.
Okay, thank you. And then one more question over here.
Sorry, can you hello. Okay. So my question is probably aimed towards Michael. So you talked about having policy certainty in a world of uncertainty. And so for monetary policy, I wondered what that looked like in a world where we don't know where the narrow is or the neutral interest rate, other sorts of quantitative things. But also at times like we are in at the UK where we don't know where the economy is moving. Is it perhaps about choosing a midpoint or the most likely avenue and saying that that's where monetary policy will go? Or is it about focusing on the end point, a bit like Draghi's done, saying that he'll uphold the euro no matter what? So I was just wondering if you have any thoughts on what that looks like.
Okay, thank you. So let's take those two. Vicky, I didn't let you in on the previous one, so do you want to start on this one?
Okay. Thinking about short-termism and long-termism, but also how can you be certain you're doing something which is right when you can't really forecast things properly? And I mean, it's absolutely true. Short-termism has been an issue, but on the other hand, as we heard earlier, the long-term policy of basically getting out of the state being a major part of the economy and austerity, which is what we got in order to achieve it from the moment the coalition government came to power and then carried on with the Conservative. I mean, I wish they were actually more short-term in the outlook then rather than long-term, because it was a disaster, and I agree entirely that this was the wrong policy to have. So if you have a long-term policy which is wrong, then you've had it, really, I mean, in terms of where you'll be going. So what you really need in terms of the monetary policy question that was asked is flexibility. And actually, when we were all sitting down to try and decide what to do, because I was joint head of the Government Economic Service at the time of the crisis, and I was sitting on something called the National Economic Council Officials Group, and just thinking about, don't question about, are we any good, were we any good? Actually, at that time, we had no idea. I shouldn't say that, shouldn't be commented on, but we didn't know how the economy was going to react to whatever it is that we were doing at the time to try and help it. So we were basically throwing things at it, a lot of money, and hoping the consumer, businesses, and so on would respond. And we didn't always know how it was going to be. And just thinking about, what Michael was saying about forecasters, I used to be a forecaster, and I know some of my colleagues with whom I used to forecast in banking are here right now. We did a little bit of the back of the envelope, but we knew that there was one element that we just did not know how it was going to react. The Bank of England that was using, the Treasury focus at the time was saying the same. The consumer. We just had no idea. Sometimes the consumer reacts positively to things you do. Sometimes you do exactly the same thing again, and then they do something different because of whatever it is that has influenced maybe their wealth or whatever has changed. So what you do, and you have to do, is be flexible in monetary policy right now. You have to continue to be flexible given the situation we're in right now. And we were flexible then. But the moment the economy started moving again, we went back to this long-termism. Certainly the Treasury did. Of saying, oh my God, we shouldn't be spending any money. So anything that was considered to be a public good, like further education, suddenly needs to be charged for. And we need to cut back. And what happened, if you think about inequality, were we actually thinking about the impact, and somebody was mentioned before, of not just GDP, but what happens to regions and so on, which actually matters. We cut back regional support. I mean, regional development agencies went. It took ages for the money to start flowing again back to the regions. Inequality between the regions actually increased. So you can do such harm by reverting to your ideology and your long-term planning. Let's just not have that. And what it should be is a series of short-term things that says skills, just as we heard, productivity generally, the environment, tax, let's think about it. And actually what I would suggest is the one thing that needs to happen is that Treasury policy, anything they do on tax, needs to go and have exactly the same type of cost-benefit analysis, impact appraisal, and all that sort of stuff that any other part of policy does. And yet we let them do it without being able to control that type of behavior. And it is, I think, completely and utterly unacceptable. So that's where I come. Short term, no ideology, but be as flexible as you possibly can with some. I think the five drivers is absolutely still the case. Skills, investment, innovation, regulation up to a point, competition, which is so important to have there and to have it work. So let's not reinvent things that, just for the sake of it, but stick to the things that we know work in the long term.
Okay. And then there's a question for Michael.
I'll be very quick here. So I just want to clarify. I said to mitigate policy uncertainty. I didn't say we could necessarily go towards full certainty. But I mean, what I would say for monetary policy, what you don't want is markets thinking, I have no idea how this person will react when something happens. I mean, I would absolutely hate to be doing a forecast now. Being in my ivory tower is actually quite enjoyable, because for the bank to release a single forecast covering the next 3 years is clearly insane. There are at least, there could be more, 3 forecasts that you want to do that you're basically averaging. So I think right now it's incredibly difficult. I was talking to a friend of mine earlier who is involved in the Irish fiscal, the OBR in Ireland, and they are now, because of the impact that Brexit and the different scenarios will have, they are now doing separate forecasts and presenting them according to each one. And I think, the bank has not gone that way, at least in the headline. I think it's a very difficult time, but it's still, we sort of want to know that our policymakers are we know what their objectives are, they communicate relatively clearly, we sort of know how they're going to react, and then when things happen, they can react. So on monetary policy, I feel that we can do that, yeah.
Okay, thank you, Michael. We started this evening with the title, Which Way Now? And I'm going to bring that back to the panelists for a final word. So for each of the panelists, imagine that the Chancellor had made the short walk over from the Treasury building to sit in the front row, and he's going to make a spring statement in about a month's time. If you were answering his question about which way now, what theme or issue would you like to hear him talk about in the spring statement? Very quickly, everybody on the panel, a quick answer, and then we're going to finish. Vera.
I think productivity is one of the major issues, and with this country and the gap to other developed countries, and
okay.
So
productivity.
Yeah. Okay.
Michael.
Well, I was thinking the 3 most important things were productivity, productivity, and productivity.
Okay. Yeah.
So I would endorse that.
Okay. Claire.
I also thought productivity.
Oh gosh, everybody's going to give the same answer.
Well, it's the Chancellor we're talking about. Depending on whether he has an influence, I would I would get him to force Theresa May to rethink Brexit, really, or yes, that.
Okay. Torsten.
Here's a political economy answer rather than productivity is definitely the economics answer. The political economy answer is, what does the country want right now? It wants some productivity growth and living standards rising, and it wants a political agenda that is unifying, that says to people a better country is possible, and it's probably, to go to some of the questions we've had here, that is a grittier engagement with the fact that political economy is messier than we thought it was, that it is harder, so honesty about how difficult it is. We've got, economics tells us how we can get central Manchester to grow faster. There's a lot less to tell us about what the answer is for kind of Burnley. Burnley, we have got a bit of an answer, but go a bit further up the valley. And there's much less to tell us about that. And so more honesty about that, and then more, but that is our objective nonetheless. It's probably what it wants. As Weber would call it, knowing the rock you stand on, even though it's a bit rubbish, but being honest about it.
It's an excellent way to stop with a quotation from Weber. Will you join me, please, in thanking the panel for the discussion this evening? And I think we reassemble in the Marble Hall for a drink. Yeah.
So that's the ultimate.